How much transparency is too much? That is a question that I just looked into for Marketplace. And specifically here, I was talking about companies' quarterly earnings. Every 3 months, a public company is required to essentially open up its books and let everybody see how much money it's earned, what it's spending. However, companies say that quarterly earnings reports they are kind of running the show because every 3 months, companies have to open up their books and they have to meet expectations. Well, these expectations are a bunch of analysts and industry experts who kind of look at the company and look at the economy and make a projection of how much they guess that company earned. It's a very educated guess, but over the last 3 months. Now, if the company misses those expectations, it is a total disaster. Target once missed its expectations by just a tiny amount, and its stock dropped by almost 25% in one day. So, companies, as you can imagine, will do all kinds of strange acrobatics to meet these expectations. They will delay hiring, they will delay projects, they will move money around. In a 2005 study, a group of economists, including economist Campbell Harvey from Duke, gave a survey to a bunch of CFOs and asked if they had ever done things that would sacrifice shareholder value in order to meet quarterly earnings expectations. 78% said yes. When he said to one of the CFOs, can't you just get on an earnings call and just level with investors and say, listen, we missed our earnings expectations by a penny, but that's because we were investing in this really important project that's going to add value to the company. We did the right thing by shareholders. And he told me that CFO said to him, this is why I'm the CFO and you're the professor. Recently, President Trump addressed this. He said that he thought it was very destructive for companies. They couldn't plan for the long term. And he wanted to move US companies to a twice yearly system. So every 6 months, they would report earnings. A lot of countries do this, including the UK. However, economist Salman Arif, who has also looked into this, said if the markets move to a system where companies only have to report every 6 months, that is a long period of no information. And when that happens, it puts mom and pop investors at a huge disadvantage because big investment firms, they can get information in all kinds of interesting ways. Sometimes they will buy, satellite photographs of parking lots, and they will use those to measure how many cars are in the parking lots, estimate how many shoppers they think went into the store, what sales were. And the less frequently companies are, putting this information out there to the public, the more valuable these satellite photos of parking lots, that kind of information becomes. RF also makes the point that US markets are the most valuable markets in the world by a lot. And he says part of the appeal of investing in US markets is that they are so transparent. He says making any change to that could make the US a less attractive investment.